A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hi folks, David McKnight here. I am the best-selling author of The Power of Zero, Look Before You LERP, The Volatility Shield, and as by now, the soon-to-be released Tax-Free Income for Life. And when I say soon, I'm talking November 17th, which is just right around the corner. So if you are looking to completely neutralize, to completely mitigate tax rate risk and longevity risk, and you want someone to help you navigate all the pitfalls that stand between you and those two objectives, feel free to head over to davidmcknight.com. Be happy to hook you up with an advisor who's seasoned and has a steady hand and then can help you achieve those two objectives. If you're an advisor who wants help transitioning your practice to a Power of Zero practice, you can do that by going to powerofzero.com. Today, we are going to talk about the possibility that you could be over-converting your IRA. In other words, converting too much money to your Roth IRA and not leaving enough money in your IRA by the time you retire. Now, let me start off by saying simply this. I will often get messages from the internet, people that email me or go to my davemcknight.com contact form, and they'll say, hey, Dave, I'm about ready to retire, or I just retired. I've got $300,000 in my IRA, and I need some help getting to the 0% tax bracket. I usually respond to those people and say, guess what? Congratulations. You're already in the 0% tax bracket. You don't need any help. You have the perfect balance in that tax-deferred bucket. You shouldn't change a thing. Now, that may seem counterintuitive to you, but it won't by the end of today's podcast. And the first thing that we got to recognize, the first principle that I want to lay out here is that in a rising tax rate environment, it's okay to have some money in your tax-deferred bucket. Like I said, you may find that counterintuitive, but remember, and you may find that counterintuitive because I've been speaking out about having too much money in your tax-deferred bucket for a long time. But remember, in your zeal to get to the 0% tax bracket, you don't want to start converting money to the tax-free bucket in a willy-nilly way. You have to be very strategic in the manner in which you convert money to tax-free. And that shifting process has to be governed by a very important overarching principle, namely that it's okay to have some money in your tax-deferred bucket. So, first and foremost, you can have too much money in your tax-deferred bucket. You can have too little. What we're looking for is just the right amount. We want to have just the right amount. What is the perfect amount? I've talked about this before. I will reprise this topic in today's podcast as well. You want to have a balance in your tax-deferred bucket that's low enough that required minimum distributions are equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. Remember, Social Security taxation could put a $4,000 to $6,000 hole in your Social Security. How are you going to plug that hole? You're going to take money out of your other tax-deferred assets along the way. And if tax rates went up to 50%, you got a $5,000 hole in your Social Security. You got to spend $10,000 to be able to pay that 50% to the IRS and then be left over with $5,000 with which you can then plug the hole in your Social Security. So it's a big deal to have your Social Security tax. And if you have too much money in your tax-deferred bucket, you may be in a position where your Social Security gets taxed. When you have too much, by the way, if you want to get a better feel for the perfect amount of money to have in your tax-deferred bucket, you can head over to davidmcknight.com, go to the top menu bar and click on the magic number calculator, and that will tell you what is the perfect amount to have in your tax-deferred bucket. It will also tell you how much you need to shift each and every year, given a certain time horizon, given a certain rate of growth, given a certain level of Social Security or other provisional income sources, so that by the time you start receiving those RMDs are going to be 100% tax-free. And again, you want that balance to be low enough that RMDs are equal to or less than your standard deduction, but also low enough that it doesn't cause Social Security taxation. Now, you got to remember, half of your Social Security counts towards your provisional income thresholds. So the higher your Social Security, the less money you should have in your tax-deferred bucket. And the magic number calculator will bear that out for you. So we've defined having too much, but in the very same breath, we also have to recognize that you can have too little in your IRA by the time you hit retirement and start drawing down RMDs, or getting to the age of 72 where when you otherwise would be required to take those RMDs. Let me give you an example. Let's say you got $1 million in your IRA and you've been listening to my podcast and you've been reading the news and you've been seeing all the debt that we've been racking up and you're like, absolutely, I am convinced that I need to get all my money shifted to tax-free. So in the very willy-nilly, haphazard way, you shift all that money to tax-free. And we're not even going to address in this podcast that we've seen people all the time that bump up into really high tax brackets because they're so overzealous about getting that money shifted over that they don't convert right to the top of whatever is the appropriate tax bracket. For most people, that's going to be the 24% tax bracket. But we've seen people that come to us and say, yeah, I listened to Ed Slott on PBS and I've been listening to they don't typically say they listen to my podcast, but I listen to Ed Slott. I've heard people say that tax rates are going up. So I went ahead and converted every last dollar to tax-free. Of course, they paid lots of tax that they didn't necessarily have to pay along the way. But let's say that you got $1 million in your IRA, you convert every last dime of it to tax-free. We won't dwell on whether that person did it over the right time period or not. And let's say that by the time you hit 72, you have absolutely no money in your IRA. Even though you don't have any money in your IRA, you still have a standard deduction. And that standard deduction is sitting there idle, languishing away, wishing that it could offset some taxable income. But guess what? All of your income is coming out of your tax-free bucket. So that standard deduction, for all intents and purposes, has been totally squandered. That means that in the process of executing your Roth conversion, you paid some taxes along the way that you didn't really need to pay. Guess what? You over-converted your Roth IRA. Now, why is it a big deal to over-convert your IRA? Why is it a big deal to when you get too much money into your Roth IRA? I like to bring up something that I like to call opportunity costs. And basically, that concept goes like this. Anytime you pay $1 to the IRS that you didn't really need to pay them, not only do you lose that dollar, but you lose what that dollar could have earned for you had you been able to keep it and invest it over the balance of your lifetime. In other words, over-converting. By giving too much money to the IRS, by not being able to utilize your standard deduction in retirement, that could end up costing you hundreds of thousands of dollars over the arc of your retirement because of that opportunity cost. You gave money to the IRS that you weren't really required to give them. You over-converted. All right. What is a typical ideal balance that we see? Now, these numbers are going to be typically for people that don't have huge pensions. So this is mainly going to apply to people that don't have pensions. By the way, if you have a large pension, your ideal balance in your tax-deferred bucket is typically zero. If you don't have a pension, this is what you're going to be seeing. You're going to see ideal balances, according to my magic number calculator, that range anywhere from $250,000 to $400,000. Again, it depends on how much Social Security you have or other sources of provisional income that you're expecting. Those other sources of provisional income might be a smaller pension, 1099s coming out of your taxable bucket. Maybe you have a fair amount of 1099s being generated because you have a large amount you have too much money in your taxable bucket. You maybe have some rental income, get some rental income properties or some farm income, what have you. So all of those things are going to affect your ideal balance in your tax-deferred bucket. They all count as provisional income. So the more of those streams of income you have, the smaller the ideal balance in your tax-deferred bucket, which means the more you're going to have to convert. But guess what? We see all the time results from the calculator that say that you should have $400,000 sitting in your IRA by the time you reach age 72. And if you've converted all of that money to tax-free, guess what? You probably paid at least 25% in tax along the way. It's $100,000. What could that $100,000 have earned for you had you been able to keep it and invest it over time? Now, sometimes people will say, hey, Dave, the standard deduction indexes to keep up with inflation over time. And it's true. It typically indexes by 3% or so per year. And so they'll say, why can I not have a magic number, an ideal balance in my tax deferred bucket that also indexes to keep up with inflation? Why is that number static? Why can't I grow that number over time? The reality is that while your standard deduction does index to keep up with inflation over time, your provisional income threshold does not. In fact, that provisional income threshold, which is the point at which, if you're a married couple, which is $32,000, up to 50% of your Social Security can become taxed. For a married couple, if you have more than $44,000, then up to 85% of your Social Security can be taxed. Unfortunately, over the last 20 years, the IRS has not indexed those thresholds to keep up with inflation. So if you want to avoid Social Security taxation, you are going to need to have a more or less static magic number in your tax deferred bucket. In fact, I would even tell you that magic number actually needs to go down over time. So maybe you need to undershoot that magic number a little bit. Why? Because your RMDs will increase over time, and your Social Security, although it hasn't been increasing a lot lately, your Social Security will also increase over time with inflation. You could eventually grow out of those, get to the point where your Social Security does cause, if you're counting one half of your Social Security, you could get to the point where one half of your Social Security in and of itself could violate those thresholds. So we cannot be in a position where we expect that the magic number will grow over time. All right. So now that we recognize that the tax-free RMD, okay, so in other words, your RMD offset by your standard deduction, now that we recognize that it's okay to have some tax-free RMDs coming out of your tax-deferred bucket, let's talk about how this fits into the overall Power of Zero puzzle. Now, remember, my approach to tax-free retirement basically says that you need to have typically between 4 and 6 different streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket. The most common ones include, like I said, Ds. So in other words, the amount the IRS forces you to take out, but offset by your standard deductions, Roth IRAs, Roth conversions, Roth 401ks, the LIRP. And then if you can engineer all that properly and you stay below your provisional income thresholds, then your Social Security is also tax-free. Now, you may have listened to my podcast in the past that talks about the holy grail of financial planning. I call that RMD, that tax-free RMD, I call that the holy grail of financial planning. Why do I call that the holy grail of financial planning? Because when you put money into that IRA, you got a deduction on the front end, you grew it tax deferred, and then when you took it out tax free because it was offset by your standard deduction. The only other investment out there that allows you to do that is a health savings account. You get a deduction on the front end, grows tax deferred, you take it out tax free. The problem with the health savings account is you can only use it for qualified health care purposes, qualified health expenses. And so you've got some strings attached when it comes to how you use that particular stream of tax-free income. So really, the RMD should be used as a complement to all of the other tax-free streams of income that we typically like to talk about. It should not be the only one. In fact, in most cases, it won't provide enough income to completely cover your lifestyle expenses. Because remember, if you got your RMDs coupled with your Social Security, unless you've got a massive IRA, unless you've got a lot of other money coming out of your Roth IRAs, it's just not going to be enough to cover your lifestyle expenses. So you want to have other streams of tax-free income that are flowing into your lifestyle, paying for lifestyle expenses. And of course, you'll have money in other accounts, hopefully, which are tax-free, which will be utilized to pay for discretionary expenses down the road, those aspirational, those shock expenses that you're going to experience invariably over the arc of your retirement. Okay, in summary, here's my main message to you this week. It's okay to have some money in your tax-deferred bucket. You want that balance to be low enough that RMDs are offset by standard deductions and also low enough that it doesn't cause Social Security taxation. Sometimes I think in our zeal to get our hard-earned retirement savings off the train tracks, we sometimes desire to get everything shifted to tax-free, and that's the massive mistake we're trying to avoid. By getting your tax-deferred balance down to zero, you will in most cases have over-converted because you will now have a standard deduction that sits idle. That means you will have needlessly paid a tax along the way, and that flies in the face of everything we're trying to accomplish here at the Power of Zero. All right, folks, a reminder to subscribe to this podcast. If you have a chance to put some reviews online for any of my books, I'd be deeply in your debt. And once again, I would be honored if you pre-ordered Tax-Free Income for Life. Remember, you can go to davidmcknight.com and download Chapter 1 instantly by simply typing your receipt number into the field that is provided. Thanks, everybody. We will talk to you same time next week.